This is the big one. This is the video where everything comes together for you. This is the video that is going to set you on a path to trading success that will make others scratch their head and question you as to why you can do what you can do. Now do remember there is a link to a printable follow-along guide to all the videos in this training series, and as always I will personally respond to any questions or comments. Don't forget, if you're happy so far, give us a thumbs up and maybe even a like on the videos. Manipulation summary. Price is the result, not the cause. You can only act when you have given birth to a belief. Beliefs are easy to manipulate, thus the price is easy to manipulate. Now we're going to move on to how the market makers actually extract profits. Profit release is the act of distributing stock back out, that which has been accumulated earlier. This is when the market makers get to make profits on a vast scale whilst allowing the outside traders to enjoy some profits themselves. However, these allowed profits are almost like a temporary loan to the traders. This temporary loan concept is why most traders will enjoy a couple of good winning runs and over the next 5 or 6 trades give all the money back, usually with a good measure of interest. Remember, this is the market maker's business, and just like any other business, you are not going to be allowed to freely walk in and expect to be given a share of that business's profits. Let's now have a look at the execution of this profit release. The execution. The execution is really the profit release. It's after you've done this, it's after you've accumulated this, you've accumulated all the buy orders that you want, you've then got to get into the next phase, which is the profit release. And what happens? How is money made? How are the market makers now making money? So once the profit release, once the accumulation has occurred, let's see the market in this case breaks onto the upside, okay, and then we can see the market comes off and then back, and so basically the market starts to rise up, and invariably we get these, what I call these drop backs or retrace. It doesn't matter what you call them, drop back, retrace is not important. So what's going on here? Well, the market makers now have the accumulated buys. The market starts to be marked up. As the market starts to come up, the people looking at the charts, the surface people, they're looking at the charts thinking, oh, now the market's going up. They can visually see, so now the market creates a belief in the traders, yes, this market is now going up. They are now willing to buy. So as the market starts to go up, they're willing to buy. And what are the market makers doing with what they've accumulated here? As the market rises up and the outside traders come in, willing to buy, the market makers are selling. They are now selling that which they bought at a lower price. They are selling into the rise, selling into a rise, and they are releasing profits. And incidentally, through here there will be an average price, and that average price they've paid might be, say, in the middle of that area. It might be the very moment anything is sold above that average price, they are making money. Even if they bought some orders here and bought some orders here, once they get above that average price, they're into making money. That's often why you will find when a market does make that initial first move, it's quite a sharp move and a quick move away to clear that area, and they can get into a profit release phase straight away. Now, I see these little drop backs on here, but I'll talk about those in a moment when we get back to them and what's actually going on here. But that is how we get into a profit release in a rising market. I just thought it was worth putting this one up as well so we can see again the same situation here. So the market then obviously accumulating sell orders, and then the market starts to go down, and obviously the releasing profits are buying back at a lower price and releasing profits that they've got from accumulating the sell orders. Now, just as a point here, I want to talk to you very, very quickly about a sort of trading truism that you might have. You might have heard this, or you may even be starting to think about this at this stage. You may even be thinking, well, hang on a minute, this area, this box, that's all very well. I can see how that works out, and I can see that if they're accumulating sell orders, the market's going to go down. If they're accumulating buy orders, the market's going to go up. But you don't know. You don't know. You're never going to know what's in that box. Now, people may say to you they do, but they don't. It's an after the effect thing, because you can never tell. I've been trading for 20 years. I do not know for certain what, there are clues, but I do not know for certain what is in that box. Okay, if I knew that, then it would be, the whole game would be over. If ever that was revealed, the whole game would be over, and trading wouldn't exist in the way it does. But you may be already thinking, well, hang on a minute, I can see that on there. So the logic here is very simple. Let's just place a buy order above the box here. Let's place the sell order below the box here. Then if the market goes down this way, we'll fill our sell order and we'll make money on the way down. If the market goes up and it breaks through the buy, we'll buy the market automatically and the market will rise up. We can set these orders up automatically on our dealing platform. It's great. Well, that's a trading truism. That's one of those things. That's the facade thing. That's one of those things that sounds so good in practice, in theory, and a lot of people will try and develop strategies about this. And it's called it's breakout. It's what I call breakout trading. Literally, it's self-explanatory. In a confined area, as the market breaks out, you trade with that. Now, I'll explain to you why that's a deadly game, which will cost you a great deal of money later on. But that's a trading truism. So keep that in mind when you see things like that and you start to think, oh, I can understand that. It's very simple. We can just put a buy or sell into there. Big cycle, mini cycle. Earlier on, we looked, and we remember the drawing we had here when we said about the accumulation of the sell orders, accumulation of the buy orders, and we had the market maker's cycle going around here. And then over here, I've got a little one. Okay, just the same, but just a little one. Okay, just the same process on there. And I said to you, I would talk to you about the drop backs, or the retraces, when a market breaks away and gets into its move. Now, what I've done here is not a very good circle on this bottom, not a very good circle on this bottom one here at all. But what I've done is, you can see, we've got, again, this is the larger circle here, which is the one we're looking at here. And then each one, as we can see in this area here, we see these drop backs, these retraces, of what we're actually observing here, which is, again, exactly the same process that is going on here. So why would this happen? Why do you have these retraces? What's going on here? Well, first off, we get the breakaway. So we see the breakaway at the bottom here. We get the breakaway, the market starts to go up. What are the market makers doing? The market makers are now pushing out to the demand, so the outside market are coming in to buy. Market makers are pushing out those and releasing profits. And as they do, they push them out, push them out, push them out, and then eventually it will sort of overwhelm that coming in. The speed overtakes and the outside market drops off a little bit. And so what happens is the market peaks and starts to drop back a little bit. Now, what some people will do at this stage is think, that it's not going any further. That's as far as it's going to go. There may be a little area to the left here, whatever they say, yep, it's not going to go anymore. They can see it dropping down. Now, what they will do at that point is they will start to sell the market. The outside market will sell. What do the market makers do? It's absolute gravy. It's immediately they will accumulate more of those orders because they know that it's going to go higher. So as the outside market starts to sell, they actually buy some more stock at this point here, ready to sell into the next rise before the cycle is repeated over and over again. And that is why we see these drop backs when we see a market going up. That is what is occurring. These mini cycle processes through here, and of course there are obviously some people taking profits as well. That is an outside traders taking profits, but that's what's occurring, that cycle as we go up. And just the same as the market's on the way down, so we see the market going down. As it's going down, we see the market lift up, so people think, yeah, it's not going any further. They start to buy the market, again the market will sell and accumulate more sells for then moving on down. So what we actually have is the bigger circle here, we have the little circles within circles there. So circles within circles, the whole business model, so the actual business model that you're seeing here is a miniaturized business model that runs actually right the way through each section of the rising market and the falling market. I told you this business is I told you this business was a simple business. It is a simple business. It's about accumulation, manipulation and profit release in all its guises, either on the larger cycle or be it on the smaller cycle. What's in a retrace? Once a market has broken from the accumulation area and is heading in a given direction, we will see areas on the chart that are generally called retraces. What is going on in these retrace areas? Now clearly the market is moving in a general overall direction, so why the need for the retrace? Are the market makers deliberately creating this? There are all good questions, answers which need to be fully understood in order to truly understand what a retrace is. Now we've talked much about the cycle of accumulation and profit release, and what we see here is exactly the same. As the market breaks out of the accumulation area, in this case we're looking at accumulation of buy orders, the outside body of traders will see this and start to buy the market in anticipation of higher prices. As demand increases, the market makers will sell into this demand, thus releasing profits from that which they accumulated earlier at lower prices. Now during this flurry of activity, the stock that the market makers are distributing to the buying demand will literally swamp that buying. At this moment there will effectively be more supply than demand, and as a consequence the price will drop back, causing what we see on this chart as a retrace in the overall price line. However, the market makers are well aware of the overall demand, so as the price drops back and some traders believe the rise is over, low amounts of selling will occur. The market makers would take advantage of this by rebuying, thus accumulating more stock at this level, ready to distribute it into the next lift. And what we can see from this is that far from being a simple retrace, it is actually an additional accumulation tactic that allows the market makers to accumulate additional stock during an overall trend, thus replenishing their accumulation of buy orders, which they will release into further demand as the market price starts to climb again. Now, just the thought to have in the back of your mind at this stage, imagine what would happen if the price, as it retraced, the market makers did not accumulate. Now hopefully you already start to realise that failure of the market makers to accumulate on a retrace would in fact cause a complete market turn, in this case downwards. So where is the profit made? In a rising market, the market makers are selling the buy orders which they accumulated earlier at lower prices. They are thus releasing profits from stock which they had accumulated during an earlier period of time. Now in a falling market, the market makers are buying the sell orders which they accumulated during an earlier period of time. This is of course a mirror image. In the case of stock they are buying back, keep in mind this is stock that they had earlier sold at a higher price by the very nature of the profit release that would have already taken place. They are in effect accumulating stock at lower prices than they had previously sold at. The profit zone. In this simple diagram we can also see the simplicity of the overall market maker's business model. It is one of accumulating stock at an overall average price and then over a period of time reselling that stock at an average overall higher price. Likewise in reverse, it's about selling at an overall average price and then accumulating that stock back at an average overall lower price. The area in the middle is simply the profit zone. Hopefully you can understand why we only need this very simple graphic illustration to explain this. It is after all a very simple business of producing repeating profits. Remember this? In this illustration we can see the larger cycle of accumulation and profit release. Within that larger cycle we can see now exactly what a retrace is. It's an exact replica of the overall cycle but on a smaller scale. Now that you understand what a retrace really is, you'll be able to look at any chart, any stock and understand what is going on. Now notice at the top of the larger cycle I've shown another elongated accumulation period. When looking at your charts, look for these areas and then retraces, and this will allow you to obtain a global overview of where in the major accumulation and profit release cycle the market is. Now just before we leave this illustration, it's worth again reminding ourselves of form and content. The form of the chart is merely showing us a retrace and does not tell us anything. In fact, it's completely misleading. By reading the content of the market, we're looking behind the facade and thus understanding the real mechanics of the overall market maker's activity and that retrace. The never-ending cycle. This is exactly what we have, a never-ending cycle of accumulation, manipulation and profit release. These three phases are what make up the market maker's business model in its entirety. It is the understanding of these three phases that will provide you with a highly successful outcome to your trading. So how do we trade the market maker's method? Well, the market maker methods provides us with a continuing sequence of events in the form of phases known as accumulation, manipulation and profit release. To put this into practice, we need to start thinking about how these phases play out and how we can become part of the process. For me, trading is like the plot of a movie. If you analyse any movie, you'll find the movie will pass through predictable sequences of dialogue and activity. This can probably be best understood by looking at, say, a modern type of movie. In the first instance, we'll be given a general review of the plot, which gives our mind the opportunity to literally project forward to the envisaged end result. As we watch the movie, all is going great. Boy gets girl, girl goes to fall in love with a boy, then invariably disaster. Everything goes wrong. Everything is turned upside down. It's an all-lost situation. It's the twist in the plot that we are not expecting, even though the movie had a very predictable outcome. Deep down we know the boy is going to get the girl, girl is going to get boy, and everybody's going to live happily ever after. But it's the twist that temporarily disguises the true outcome. Note it does not change the outcome, it only disguises it, which is exactly the purpose of the manipulation phase in the market maker's business model. When you're trading, always look for the three-act story. Always look to be discovering the plot, and when you discover that plot, you'll enjoy success on an unprecedented level. But you know what? There is just one stage of this story that we can focus on, and if we get that stage correct, everything else will fall into place. What's in the box? The contents of the box will always reveal the future direction of the profit release. Here, when I'm using the term box, I'm referring to the accumulation area and thinking of this as a box-like structure. However, I am not thinking of this in terms of the form it might take to take on the chart, let us say on the shape on the chart, but rather the contents of the box-like area. As an example, if we were aware of the contents of the box, in this case being an accumulation of sell orders, we would be highly reluctant to buy the market as it moved up towards any area marked within the A. We would of course be looking for misdirection and manipulation. In other words, we would be looking for ways in which the market makers would be trying to lure us into buying the market. As a further example, as the market maker continues on up past the level at A, we would be in a position to identify this as stock taking or running of stocks, providing us with further proof that the contents of the box as being sells. Now we'd be in a position to sell this market and profit from the subsequent, what would be default, downwards movement. What is a default move? The default here is something that must happen. If the market makers have been accumulating sell orders, it would be commercial suicide to then take a market in the upwards direction, because every time the market moved higher, the market makers would be losing money. The same likewise in reverse, if they've been accumulating buy orders. Now, since we can safely assume that the market makers are a profit-driven business and have no intention of losing millions of dollars on a single move, we can by default say that if the market makers are accumulating sell orders, the default market move will be down. If they've been accumulating buy orders, the default move will be up. Maybe now you can see the value in discovering the contents of the box. Discovering the default move. The default move is discovered by observing the market maker's accumulation tactics. For example, if we were to observe manipulation that contains something like the running of buy orders, we could draw a solid conclusion that these buy orders would be adding to the overall accumulation operation currently in progress. For example, it would make no logical sense and again be commercial suicide to be accumulating buy orders in the next moment accumulating sell orders. After another example here, looking at the location of A, we have seen that the market be driven above A and then drop away. We would confirm this as stop taking. This would automatically know that the previous accumulation area, highlighted in blue, contained an accumulation of sell orders. By default, this market would be going down and we are presented with a great selling opportunity. Let's now expand on this stop running a little more. Support and resistance. I've deliberately popped in this support and resistance diagram after we've just discussed stop taking. What I would like you to consider regarding this drawing is how support and resistance is more often than not the market makers setting up areas that can later be used for accumulation purposes. You'll quite often hear on TV stations that are discussing markets about how there is a major support level at a given price. This type of statement will often encourage traders to buy the market and place stop loss orders at this so-called major support level. What happens then is 2 or 3 days later the market is quickly driven down through this support level, which triggers an avalanche of selling that the market makers can use to either continue the market on downwards, or if the intention is for the market to go up, they can accumulate all the sell orders as they trigger, thus giving them a massive stock of buy orders to later sell into a rising market. I hope this will encourage you to listen out for statements made about support and resistance levels and to also observe these on your chart so that you can profit them in the same way that the market makers are profiting from them. Stop taking or running. Now, just as a side note here, stop running or stop taking is one and the same thing. Some people will say stop taking and other people stop running, but they really are saying the same thing. The information that we're after is the contents of the accumulation area, here again shown by a box-like area. Once the market had broken free from this box-like area, moved up to A and then travelled down to B, we would know without doubt that a significant number of traders would have placed stops above A. If the market makers wanted to add to the accumulation that had already taken place in the box-like area, all they have to do is drive the market up to breach that level at A, marked here at C, and this will have the effect of triggering all the buy stops placed by traders. As you now know, the other side of a buy stop is a sell order, allowing the market makers to take the sell side ready for the default move down. Now to this point you probably noticed that I've mentioned form and content quite a lot. Well, it's true, and this is a theme that we continued. By looking at the form of this drawing, it shows seemingly almost random movements with the market not moving anywhere of any significance. This is the type of market that many traders get caught in and subsequently lose money, even though they may have correctly predicted the overall direction early on. By understanding the content, not only do we understand what is going on, but we're also provided with the best possible entry, the lowest risk entry and the highest possible reward entry. And I'm sure you agree that that combination offers you unprecedented opportunity to continuously profit from market moves. And now it's time for a warning. If you were to simply look for stop running without fully understanding the market maker's business model and without interpreting that stop running relative to the accumulation area, you will likely suffer needless losses. Should you engage in this type of market reading activity, you will have automatically reverted to looking at the form the market is taking, the shape the chart is producing, as opposed to the content of the market maker's business model and the content of the accumulation area. It's time for a little more on patterns versus recognition. Recognition is an interesting topic here, because what have we got drawn up on here? If we look at this, if we look at this here, we can see we've got a circle here, okay, and here we've got a sort of circle but with a bit missing here, and then here we've got some curved lines, some gaps and some dashes, and here we've got a little what is in effect a small circle. Now when we actually look at those, if I actually covered this one off here, and then we covered this one off here, and we're only left with this one here, that's all we could actually see, this one here. Could we say it's a circle? We could. Why? Because we can see the form that it takes. Okay, we can see the form that it takes. We can see that that is roughly the shape of a circle, and so our mind will literally fill in the gaps as we go around, and so our mind creates this. Now the problem with this, of course, twofold, because obviously if you're looking at chart patterns and just reading the facade and you see a pattern and it sort of matches a pattern last week that did something, you say, oh, that's that pattern that last week, oh, that's now a sell. You're in trouble, because you cannot carry that forward, if you like. You can't take that forward to then trade, because we're talking about different set of circumstances. It may well be that in the accumulation, manipulation and profit release, we're nowhere near in the same cycle. There's nothing there in the same cycle at all. Okay, so this comes back down to form and content. Okay, form and content. Which is the form, which is the content. And we want to look at the content. So by looking at the market, we want recognition of what? We want recognition of what? We don't want recognition of the form. So we don't want recognition just to see the circles on. We want to see recognition of the content. Okay, I assume you could easily fill that word in there. We want recognition of the content, not the form that the chart actually takes. So that's constantly, how do we do that? We do that by being connected to the box and looking at the content of how the market maker's business model is unfolding at this time. Well, I told you that was a big one. You've come a long way. The effort you have put in is now going to pay off big time. Now in video 8 coming up, you are going to get the icing on the cake. You will learn some secrets that will set you way apart from other traders. Now I'm not going to say too much about that here, other than you are 90% there. You're at the final fence. It's a short step now to an incredible, secure financial freedom. I'll see you over on video 8.